The big earning week continues with Walt Disney having reported just before market open, and we can see they are down over 8% so far on the day. Now we're going to take a deep dive, understand why they are down after reporting their earnings. We're going to analyze not just what the article is talking about here, but we're going to do a deep dive into their latest earning presentation. As always, we're going to take a look at this company, their growth on their top line revenue, their bottom line net income. We're going to look at the health of the company, their total cash versus their total debt, and look towards both insiders as well as institutions to understand if they have been buying or selling. And we will also look at the underlying metrics like the free cash flow growth as well as the return on invested capital. And as always, very importantly, we want to put it through the valuation model. What is the intrinsic value? What is the acceptable buy price? Given that investor margin of safety, as well as looking towards Wall Street to see what they're forecasting for the next 12 months. So let's look firstly a quick historical performance, and we can see two buy ratings, both seeking alpha analysts as well as Wall Street, whilst we have a hold rating from Quant. We do know they're trading in the mid to upper end of the 52-week range, and for those that missed it, they did recently announce a dividend. We can see on a trailing 12-month basis 0.26%. On a forward P basis, 24.12. Now remember, the S&P 500 is trading at around 22, so marginally higher. If you have been an owner of Disney, the Walt Disney Company, in fact, you'd be up over 3% over the last 12 months. Over the last 10 years, you would be up very marginally, just 32%. Now look, it doesn't include dividends reinvested, but over the last 10 years, that isn't the greatest return. And we do see their all-time highs around 3 years ago now, trading at just under $200. And as we can see, the share price is now around half of that. So is this extremely undervalued? So let's take a look at the earnings, and we can see just some of the key points from the article. They did top the earnings estimates, whilst their revenue, as we can see, was reported roughly in line with analyst expectations. Some good news, as both Disney Plus and Hulu reported a combined profit in the quarter for the first time ever. However, we do note that when combined with ESPN Plus, the whole streaming unit reported a loss of $18 million in the quarter. Not great, especially when you consider that TV revenue and box office sales slumped in this quarter. So looks like some mixed ratings, some mixed report. Let's find out a little bit more. And what we can see here, earnings per share, a nice beat, 121 in fact adjusted versus 110 expected. In terms of the revenue, not too far off. Yes, it was a miss, but very marginal versus the $22.11 billion that Wall Street were hoping for. Now, one of the main things that essentially investors do look at with Disney is that core subscriber growth, and we can see it did increase by more than 6 million in the quarter, and they now have a total of 118 million global customers, so that is a positive sign. We're going to take a look to see how that is in fact quarter on quarter, and when we take a look at the parks and experiences, it is up 7% to just under 6 billion, with international sales up 29%. In fact, one of the reasons a lot of increased attendance as well as higher prices at their Hong Kong Disneyland resort. Now we'll take a look, but before we do jump into the historical performance, we do want to make a note that they did report a loss attributable to the company of $20 million compared with a profit of $1.27 billion, in fact the same quarter last year. Now a lot of this was in fact a one-off restructuring and impairment charge that we can see. So let's take a look at this in a bit more detail. In terms of their top line revenue growth, as always, we want to see 3 to 7% year-on-year growth as a minimum baseline, at least keeping up with inflation at 3%. September 2014, they reported $49 billion, as we can see on the top line revenue. When we look at the more recent annual report, $89 billion. So positive to note, they have nearly doubled their top line over the last 10 years. We do note a little bit of inconsistency year on year, but it is overall moving in the right direction that we do want to see as investors, and we will look at the percentage increase shortly as well. In terms of bottom line, well actually it has the opposite effect. Just purely looking at it on a graph perspective, it did in fact increase up to September 2018, and since then has started to come down quite dramatically, but then again the share price has in fact halved from around $200 we saw 3 years ago. Bottom line, net income $7.5 billion in 2014, $2.3 billion in September 2023. So What we will want to see from the next annual report, in fact the September 2024, we want to see a nice increase to that bottom line net income. Otherwise, this is already a little bit of a red flag indicator, increasing revenue, whereas we see in fact decreasing net income. So let's take a look at the health of this company. So their total cash versus their total debt, 3.4 billion in 2014, 7.2 billion in that latest quarterly report. So they have in fact more than doubled their cash position, as we can see a very large increase from 2019 to 2020, and has decreased slightly since then, but over the longer term they are holding more cash. How does that compare then numerically and directionally to that total debt? 15 billion in 2014, 48 billion in their latest report. So whilst their cash has doubled or nearly doubled, it isn't as much as their total debt, which is very high and has been increasing over the longer term. This is very important, especially they have just started to pay a dividend, so we also need to consider the total debt as well as the net debt to EBITDA metric. Earnings per share then, so how have they performed quarter on quarter? Well, over the last 4 quarters, they did in fact beat on the last 3 earnings per share, and as well the more recent one. We do, however, note they did miss on one. So 3 out of 4, not bad. And what is good to see is over the next 4 quarters, they are expecting double-digit year-on growth to the EPS. Very good, very nice to see. But again, we do need to see what they actually report, not just what they're estimating. Now, in terms of looking at the valuation grade, a D-, so not great at all when comparing to others in the same sector. We do note then a P on a non-GAAP basis, 25, 24.72, and when we see the sector median, 13.89, we can see it is some way away from that sector median. Again, it does come down to whether or not you do believe it should be trading at a premium to the sector. So we'll take a look shortly, but these again, the metrics for those that want to see other valuation grades. When we look at their growth grade, they did get a B, so not great, but also not the worst. Year-on-year growth, 5.35%, sector median coming around 2.48. Forward-looking, 5.36. We can see the sector median 2.68, so it is a little bit lower. And one of my favorite ones to look at is that earnings per share on a forward basis. Over the next 3 to 5 years, they do expect it to compound annually at around 17.52%. with others in the industry on an average perspective 10.75. So positives, as we did see, valuation not so great, growth looking okay. When we do take a look at the profitability grade, we do get an A+, looking very strong. That is the best score they can obtain. Let's look at the gross profit margin, 34.33%, sector median 49, so a lot better. So that is a pretty poor rating, let's be honest. But then when we do look at their net margin, it does look better than the sector median, 3.39 versus 2.68. Now, one thing we do quite like from this is their cash from operations, significantly higher, 13 billion versus 293. Now look, one thing that I will say is there are a lot of different valuation methods on profitability grades, as well as looking at their growth as well. Again, this is data. If you want to use it in any way for an investment thesis, then it is there available, but there are a few key ones that we always do like to touch upon. And in conclusion, a D- on the valuation, they get a B for growth, and profitability does sit at an A+. And as we said earlier, 2 buy ratings and 1 hold. Now, we also want to take a look. It is a little bit difficult when we do compare them to similar, essentially, companies in the industry. We have the movies and entertainment. So we have Netflix, we have Spotify, we have Live Nation, as well as a few others like Warner Bros. Discovery. Now, over the last year, this is total return. So including those dividends reinvested, we do note they are, in fact, up around 3.5%. Not the greatest, let's be honest, that is pretty poor. In fact, one of the worst performing. When we extend it over the last 5 years, we see they are down negative 20%. Again, no surprises, as we did see all-time highs of around $200. When we extend it over the last 10 years, they are up, however, marginally 44% over the longer term. Not great at all, although we do see there are some others in the industry that has performed worse significantly. We have TME up 9%. We have Warner Bros. Discovery down negative 79%. So again, just bear in mind they have performed pretty poorly over a 10-year period, but as always, the past performance is never an indicator of future performance. In terms of looking at insider ownership, well, 0.1%, we do know a fair amount of insider selling over the last 12 months, 2.14 million, with only 99,000 worth of buys from one insider. Now, you just have to look to the more recent quarter to see that insider selling, $226,000. And when we take a look to see who exactly they were, we do know on the 1st of April, the EVP did sell over 1,800 shares at a price of $122, and we can see that total transaction there. As always, whether or not you include it, information is there, that full transparency, both buys and sells. Personally, I do believe that the buying has more of an impact on the overall analysis, as insider selling could be many reasons why that is happened. Current institutional ownership, 66%. We see 11 billion of institutional sales over the last 12 months. A lot more buying, not just over the last 12 months, as we can clearly see here, but in fact in quarter one as well, 2.38 billion versus 1.47 billion sold. And we also note the last 4 quarters, so every single quarter in 2023, institutions have been buying a lot more than they have been selling. Again, always do your own due diligence, never copy what these institutions do. Now, we just want to let you know we have released our latest free weekly article. If you want to gain access to this or any others, all completely free, click on that pinned comment below and you can sign up. And just to let you know how to find undervalued stocks, this article we run through every single website that we do go through on this channel. Let's take a quick look at their earnings presentation before we look at the underlying metrics and a few things we wanted to point out. So this was essentially their first slide. We can see they are targeting 25% growth in the earnings per share. Now this essentially is an upgrade to their previous guidance of at least 20%. So they are expecting to increase at a very strong rate. Now they're looking to aim for around 8 billion in free cash flow this financial year. And one thing that I thought was quite interesting, we don't hear a lot about this stock, is that in Q2 they did repurchase around 1 billion of stock, and they are looking for the whole fiscal year end to be around 3 billion. As always, I'm sure a lot of you are aware they did in fact declare a dividend as well, and is a 50% increase from the January dividend. So lots to like from this, but when we do look at the details, quarter 2 results for fiscal 2024, in comparison to the same quarter in 2023, their revenues has increased, although marginally. Their income before tax, we can see, has reduced quite dramatically. Operating income is up. Now their earnings per share is down. However, when we do exclude certain items, we can see here it is up 121 to 0.93. Finally, the only thing we did want to bring out from the rest of these slides, there was a lot about the individual income segments, but a lot of things that investors do like to look at are those subscription increases or decreases, whether it's this company or Netflix. It does seem to be one of the key performance indicators. What we can see in terms of Disney Plus on a domestic basis, a year-on-year increase as well as quarter-on-quarter increase. So that is a positive sign. We just wanted to draw out, though, however, that the Disney Plus international subscribers has reduced from 65.2 down to 63.6 in the quarter. So something just to be aware of, as this is one of those businesses that they would like to see increase year on year, especially with the subscriptions. As we saw with Netflix, they are increasing their subscription rate at a very, very rapid rate. Now, in terms of looking at dividend safety, as they have just paid a dividend, we don't have the score yet. Market cap 214 billion. It is a mega cap company. Now, in terms of looking at the dividend growth, what we can see is they did in fact cut their dividend not too long ago, hence why over the last 5 years we see negative 29% and over the last 10 years negative 10%. As we did just see earlier though, they have increased their dividend from last year by 50%, so that is a strong sign if you are a shareholder, and we can clearly see that over here. In terms of looking at the payout ratio, as they have just reinstated that dividend, it is looking to be very low. 2023, 11%. 2024, even after the increase of 15%, 18% in terms of their total free cash flows, does go to show us that they should be able to continue to increase it at a very rapid rate, at least double digits. That's something we will keep our eyes to and inform of any updates. Free cash flow, now this is very important. We do always advocate on the channel to invest in companies that increase their free cash flows over the longer term. We do note it did drop significantly and failed to recover during that COVID period. Now what is nice to note, 2023, 2.68, so very positive. 2024, as we did just see in that investor presentation, that they are expecting around 8 billion this fiscal year, so that is very strong. They are anticipating, in fact, a lot of growth from the previous years, where we do see it has been hammered down and should be higher than the 2018 peak that we see over the last 10 years. Now, in terms of looking at the sales growth, percentage-wise, we can see 3 to 7% is what we stated. A little bit inconsistent, but overall it does look very strong. 23% in 2022, 7% in 2023, and hopefully we can see around a minimum 3 to 7% in the full year of 2024. Now, just another way to explain what we looked at earlier on the total sales. Shares outstanding, now as we have seen, they did a lot of, in fact, share buybacks from 2014 to 2018. They then reversed that, as we can see, in 2020, and now they are anticipating 2024 $3 billion worth of share buybacks. Very positive to note. But overall, we do in fact see net dilution of your position in this company, 1.76 to 1.83. It is positive to note, though, that they have started to return that excess cash to investor pockets through the share buyback. ROIC, typically we only like to invest in companies that have a minimum of 10%, just to give us faith that management are able to effectively allocate their capital. Now, it did drop significantly from the highs of 2014 to 2018. The only positive to note here is it has started to increase. Hopefully we see that continued momentum into 2024 and beyond. Now, margins, again, they have suffered quite significantly. There was a massive drop off from the highs of 2014 to 2018. Again, ideally, I'd like to see a minimum of 16% here. So a little bit of a worry that it has dropped. But again, a positive to note is the fact that it is starting to increase. And we also note that when the margins were very high on both operating and free cash flow, the company was also reflected in the price. Now it is down, in fact, half of the all-time highs. Same with the free cash flow margin, although we do want to see at least 5%. So nice to note in 2023, trailing 12 months looks to be increasing at 9% as well. Finally, we get to the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. Remember, this shows both balance sheet strength as well as dividend safety, and these are the number of years it would take the company to pay off all of that debt net of cash on hand. We want to see below 3, so nice to note it has come down from the all-time highs in 2020, 1.99 in 2023, expected to increase slightly in 2024 to 2.08, but as we can see, no real worries if it does manage around that 2 level. Balance sheet looks strong as well as the dividend looks to be safe. Let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we go through Graham's valuation, multiples, the DCF model, as well as the dividend discount. Now, none of these are really relevant for Disney other than the discounted cash flow model, so we'll jump straight into that for today's episode. We have the free cash flow year on year, the average growth rate around 50%, looking very high. Now remember, they are anticipating $8 billion for the 2024, so we have put that in as the starting point, and we've gone for around 12% increase year on year. It is much lower than the average growth rate and roughly in line with analyst target. Now we then use the discount rate of 8% to get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding to get an intrinsic value of around $123, giving us an undervaluation signal. Now bear in mind, if you do believe that these numbers should be higher or lower, you can always grab a copy of this model by clicking on the pinned comment below and run your own numbers through and get to the intrinsic value of companies in your own portfolio or those on your watch list. So the intrinsic value for Disney in today's episode is purely the DCF model price of $123. With the current price of $107, we do use a margin of safety of 10% and we allocate on that if we believe it meets 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that for Disney, it would be a buy at $111. At a 15% MOS level, it isn't quite there yet, not too far off, but it'd be around $105. So today's episode for Disney, based on the estimates, we do anticipate a 10 to 15% MOS level. And in terms of Wall Street and their expectations over the next 12 months, they have upside of 20%. They believe a price target of $129 above the intrinsic value of $123 that we have calculated. As always though, do let us know your thoughts in the comments below. Is this one you are looking to add? Maybe it's on the watch list if it does dip further, or for whatever reason this isn't a company you are anticipating to add to your portfolio. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.